My name is Darren Carlett, and I'm the Managing Director of Dual Edge Research. Dual Edge publishes 2 weekly newsletters. The first is a stock and option strategy, which is covered in the Bull Strangle newsletter. The second is a commodity future spread strategy that is covered in the Smart Spreads newsletter. This video is dedicated to the Bull Strangle strategy and is the first of 4 videos. Okay, now let's do a high-level overview of the strategy. So as an introduction, we are combining a stock and dual option income strategy. So this strategy entails buying the stock and selling both a covered call and a cash secured put, both of which are out of the money strikes. And we'll talk a little bit about out of the money, in the money, at the money at a later video. But the bottom line is, the best example would be $50 stock, $52 call, $48 put as an example. The goal is to earn an options premiums while maintaining controlled risk on the stock. So the strategies combined, it really combines 3 strategies into one single position. You are long the stock, which allows you to participate in price increases, and if the stock happens to pay a dividend along the way while you're holding it, you'll receive that dividend. You're going to have a covered call. Covered means if it does close above the call strike price, you will have the stock called away. So it is covered, but it limits some of the upside potential in exchange for the premium that we receive. And then on the put side, that is a cash secured put. Some call that a naked put. Actually, that's the terminology that you'll see me use throughout. So you're generating income while creating an obligation to purchase additional shares. So bottom line is, if the stock price closes below your put strike price, you will buy 100 or however, whatever increment you have, more shares of that stock. Now, the strategy purpose is to earn income by selling options on both sides of the stock price. Earlier I mentioned $50 stock, you're selling a $52 call and a $48 put as an example. You're using these collective premiums to reduce the break even on the long stock. So using that example again, your break even goes from $50 where you purchased the stock down to $46, which is the $2 on each side that you're collecting in premium. So your break even now is $46. And this works best in a range bound or bullish market. But one of the things that you'll kind of hear from me as we go throughout this and how I trade the strategy, I'm not trying to guess where the market's going to go. There are a lot, if you go out and you look at covered call strategies and you go out on the YouTube or on the internet and start doing some investigation, you're going to generally see these strategies described as, if you think the market's going to do this, then you do that. That's not part of the strategy at all. I'm generally going to go in with the same strategy pretty much week after week after week, and I'm ignoring what I think the market's going to go do. Now, there are some exceptions to that, especially when you get into what I would call a bear market. I think your aggressiveness needs to drop, but generally speaking, because most markets are bullish or range bound, we're going to be using the same strategy pretty much throughout. Now, this strategy can enhance returns while keeping risk measurable and structured, but it does require discipline and good trade selection and effective risk management principles. Okay, now let's talk about some of the benefits of this strategy. I think the centerpiece of the entire strategy is what I'm calling rock solid stock picks. I'll describe this in great detail in the second video, but obviously picking stocks that are going to outperform the S&P all by themselves without the options is a great starting point. And I have documented a 76% profit rate on individual trades. Now remember that a trade is got three components to it: the stock, the sold call, and the sold put. When you look at those in totality, I've got a documented 76% profit rate. And that's since inception in February of 2024. The next is a proven investment strategy. Over that time, again, since inception in February of 2024, the returns are over 2.4 times the S&P 500 on a return on investment percentage. It's actually closer to 2.55 right now, but I want to give myself a little wiggle room here because it does change from week to week. Another key benefit of the strategy is variations. So I'm going to be talking about returns mainly in terms of the covered call with the naked put strategy, but you can just do a covered call only. You could turn the sold put into a put credit spread, which reduces the risk somewhat, or you could just trade the stock all by itself. So there are a variety of different variations to this that helps to fit into your risk tolerance profile. And it might also be that you may decide to vary the strategy based off of your view of the market environment. And then lastly is low maintenance. And I described this a little bit earlier, but the bottom line is we're going to place all of our trades on Monday morning, and then we're not going to do anything with it at all until the next Monday morning, where we are closing out any trades from the previous expiration cycle. All right, next let's talk about the core elements of the strategy. And I'm going to describe each of these in quite a bit more detail, either later in this video or the next. But the first is picking quality stocks. And again, I've got a very detailed section on just the stock picking alone. But we're looking for what I would call technically strong stocks. And a key element of what I would call technically strong, I'm not looking at high flyers, okay? I've actually seen that when the market does sell off, the high flyers are the first to go. I'm looking at stocks with strong support, okay? I'm using these time-tested stock engine searches in order to kind of get a big list. I'm generally starting off with a list of stocks that is well over 100 and then narrowing that down to about 20 each week. Some of the criteria that goes into those search engines is that I want my implied volatility to be at least 35%. And actually, I'm generally going to be looking more about 40 or 45 and higher. My last price needs to be between $10 and $120. Now, that range is going to vary based off of how much you have in your investment account. If you're trading a very small account, you're obviously not going to be able to trade a $120 stock because that's going to require 12 grand just to purchase the stock. So that range of prices is going to vary on your investment level. I'm looking at open interest to be greater than 25,000 contracts. And a very, very important part of this is that I am excluding any stock that is going to announce earnings throughout the holding period. Now, each holding period is going to be 25 days. We're buying on Monday and we're selling 4 Fridays later. So we don't want to see any earnings announcements during that period of time. A next element is stock options. And there are really 4 different sides to playing or buying and selling options. You know, as a buyer, in a call, you have the right to buy the stock at a certain price. And as a buyer of a put, you have the right to sell the stock at a set price. When it comes to selling a call, the seller of a call has the obligation to sell the stock at a certain price. I keep using the $50 stock, $52 covered call analogy. If the stock closes above 52, you sell that stock at 52. And then a put that is sold has the obligation to buy the stock at a certain price. And again, using that same analogy, you sell a put at $48, it closes below that, you're buying more stock at $48. The next core element is kind of how the trade is constructed. So we're going to buy stock in 100 share increments, and then we're going to sell both a call and a put, a call above and a put below, that expires 4 weeks out. Now, we'll talk about this in the very next box here, but we have to use weekly options, obviously, in order to go do it in these weekly cycles. And so going and kind of provide an example of this, and I'm using kind of this August 4th, 11th, 18th, and 25th opening dates. We are going to use weekly options during the August 4th entry, and we are going to be selling a call and a put that expires on August the 29th. And you see how this just progresses down through August the 25th. Now, for the August the 25th cycle, that's the opening date, with expiration on September the 19th, we're going to mix in monthly options into the analysis. We may have some weeklies that we'll go ahead and trade, but this is our only opportunity out of this cycle to trade monthly options. So we're going to throw those in there as well. The next core element is the market environment. And I'm going to walk you through a little bit later an analysis that I did using data from 1994 all the way through to, 1993, all the way through 2024, where I've taken and broken the market down into 6 segments based off of 3 simple moving averages, the 20-day or the 50-day, the 100-day, and the 200-day. Long story short, and I'll go into more detail on this later, I'm going to classify the market as red, yellow, or green, with us being the highest investment level at green and the lowest at red. And that's for obvious reasons. I back tested this, and I'll go through all those results in a later video. But bottom line is we're going to be fully invested, or 75% being fully based off of my strategy, when the market has the highest probability of going up, and we're going to be the least invested when it has the highest probability of not going up. And the last thing is diversification. I am a stickler for being very broadly invested across these 11 different market sectors. Now, some of these, like real estate and utilities especially, there's not a lot of stocks that meet the stock quality pick criteria that I described earlier. So generally, we're kind of spreading out across 8 or 9 of these sectors. But being diversified across market sectors is a very critical part of the strategy, as well as being diversified across the stock price and the implied volatility of the stock. Okay, we don't want to be trading a whole bunch of stocks that have a $10 price, and we don't want to be trading a whole bunch of stocks that have a 110% implied volatility. So we want to kind of diversify across market sectors, stock price, and implied volatility. Okay, now let's turn our attention to the video series overview. As I mentioned earlier, there are 4 videos in this series. This is video 1, of course. And the agenda for this video, we've already done the high-level overview. Next, we'll go into an explanation of options, and we'll get into quite a bit of detail in terms of how the options work. We're going to talk a lot about intrinsic value versus time value. Now, you'll hear these terms as intrinsic versus extrinsic. I don't like to use extrinsic because it gets me confused with intrinsic, so I just replace extrinsic with time value. But the bottom line is, if you're in the money or not in the money, it has a big impact on the price of the options. And then we're going to talk very significantly about a lot of data and a lot of research that's gone into, buyers of options versus sellers of options. And the short version is that selling options has a much higher win percentage than buying options. And I'll show you all the data on that. Video 2 gets into the strategy in quite a bit of detail. And we're going to start by playing the odds. And again, that means selling versus buying options. I'm going to go through the picking quality stocks elements of it. The short version, as I said, we're looking for stocks with strong support versus high flyers. And this is something that I'm very proud of the results that we've been getting, especially over the last several months as I kind of transitioned more into this support structure. We're going to talk more specifically about trade construction, and then we'll talk about how to play it smart, with how you manage the trade. And there's really not a lot to do with managing the trade, but we do want to make sure that we enter it the right way and that we're, disposing of the trade if we get are still holding the stock at the end of the expiration cycle. Video 3 is all about risk optimization. I've developed 6 risk rules that we'll go through in detail. I'll go through the variations to the strategy that you can implement. Remember, we talked about the core strategy is the covered call and naked put, but you can also have a put credit spread and just a covered call or just the stock. So those are the variations. And then we'll get into the back testing that I described earlier on the market environment using data from 1993 through 2024. So it's a 31-year time horizon. And then in the 4th video, we'll go through the newsletter that I put out every weekend, which includes the market recap. It has an open trade update where I follow all elements of how the trade is progressing, including charts of the stock with the call and put strikes listed right on there. I'll then get into the watch list candidates. It's usually about 20 a week, of which I'm going to trade myself personally 5. And depending upon your investment amount, you might be trading 2 to 5 stocks every week. And then there's a whole section in each newsletter about the performance summary. So one thing I'm really big on is I'm always going to show how it's doing. Okay, you're not going to see me recommend a stock, have it lose money, and then never talk about it again. Okay, that the good, the bad, and the ugly is going to be in every newsletter, and I track not just the trades that I actually place, but I track every trade that was listed in the newsletter. I have a historical record. Now, I just started this about in May of this year, but starting in May of this year, I have a record of every trade that's been in a newsletter. Okay, so we're going to start this whole next section of this video with an overview of stock options. Okay, the first part of the options overview is just a simple definition of what an options contract entails. So what is an options contract? It is a financial contract that gives you the right to buy or sell a specific quantity of a stock at a predetermined price before a set date. Now, an example of this would be to use Apple as an example. Now, I don't even know what the current stock price is right now, but let's just assume it's $200. In this example, we are going to buy one Apple call. It's going to have a strike price of $210, which is out of the money because the stock price is $200, and we are buying an option that is $210. And by the way, we don't buy options in this strategy, but I'm just trying to explain options contracts at this point. It's going to have an expiration date of August the 16th, which I assume is 20 days out. And the option cost is $2.50 per share. Now, we have to buy shares or contracts of options in 100 share increments. So using this $200 example, that'd be a $20,000 purchase. That's why we don't trade stocks, over $120, because that gets a little pricey. And the total cost of the option would then be 100 times that $2.50, which would be $250. Okay, so now let's just kind of look at that, and as we kind of match up the individual components of that. So when you look again at the definition, it's the right to buy a specific quantity of stock at a predetermined price at a set date. So we're buying 100 shares of Apple with a $210 strike that expires on August the 16th. Okay, let's talk a little bit about some frequently used terminology. And this is something that I actually kind of figured out talking to my wife. I use these terms interchangeably, and I found in talking with her it got to be really confusing when you kind of talk about the actually different terms for the same thing, basically. So I'm not going to assume that everybody's familiar with this, but the bottom line is that if you say that you're long, that's like buying, and buying is a bullish strategy, right? So if you say you're a bull, that means you're a buyer. And buyer could mean not just that you're buying an option, of course, but that you want the stock to go up. We're going to sell a call, but that profits if it goes up, right? And we're selling a put, which is also going to profit if the stock price goes up. So long doesn't necessarily mean that we are long the option. We're long the position, which means we're buying the stock and selling the call and the put. Bottom line is those are all bullish terms. And the opposite of that would be not long but short. And instead of buying, we're selling. And of course, selling is a bearish strategy. So anyway, you'll hear these terms when you're hearing people talk about the market. They'll use these terms interchangeably. Just want you to understand, kind of what that nomenclature generally means. Okay, we talked about this element earlier, but I think it's important to kind of go over it again in a little bit more detail. But this helps to kind of frame up really the 4 different scenarios for buying or selling options. So to review, you can either be a buyer of a call, which gives you the right to buy at a certain price, or the buyer of a put, which gives you the right to sell a stock at a certain price, or you are a seller of a call, which gives you the obligation to sell stock at a certain price, or you can be a seller of a put, which has the obligation to buy stock at a certain price. So the easiest thing to keep in mind on this is that if you are a buyer of a call or a put, you have the right to buy or the right to sell. Whereas if you are a seller of a call or a put, you now have an obligation to sell or an obligation to buy. So that's the easiest way to think about it. And of course, I'm going to walk you through some details on how all this works, but we're sellers here, okay? So I'm trying to give you both sides, but keep in mind that this is a selling strategy. Okay, before we go any further, I thought it was important to kind of talk about the many different option strategies that are out there. Now, I'm not going to drain this slide and go through each of these. I just want to kind of show that there are a very wide variety of option strategies out there. The top part here is literally what we're doing. This is the most basic strategies, and a lot of people would call this kind of the beginner level. But I don't think you need to go any further than this. It's not like we're progressing to the most advanced strategies, because I think this level works quite well. But if you look at some of the intermediate strategies, you can do a vertical spread, you can do a straddle, you can do a strangle, you could do what they call an iron condor or an iron butterfly. And then you can see on the advanced, there's 4 different options for that as well. And I don't even think this literally captured all the different different kinds of strategies that are out there. The key thing here is that we are going to be focused on the most basic elements of this strategy, of the option strategies. But I did want you to be aware of a wide variety of other strategies that are out there. Okay, let's kind of further the example here a bit and illustrate kind of the option buying versus selling. So we're going to use this Groupon stock. So the underlying stock is Groupon, symbol's GRPN. The strike price is $40. The expiration is August the 1st, and the premium is $2. Now, this is kind of an oversimplified example. Obviously, if you're buying, you're going to be paying a little more than $2, and if you're selling, you're going to get a little less than $2. But we're going to keep it simple and just assume that both sides are getting the same price at $2 here. Now, one thing about markets that I think is pretty well understood is that there is a buyer and a seller on opposite ends of every transaction. So obviously, if you have a bunch of buyers and no sellers, the price is going to continue to go up until the sellers step in, or vice versa. Okay, but if you just want to kind of look at the buyers versus the sellers, we're going to assume that Jack is an option buyer and Jill is an option seller. So when this initial transaction begins, Jack as a buyer is going to pay a premium for the option. And in this case, we're assuming a call option. And Jill is going to collect the premium. So again, we are assuming $2 in this scenario. And so going back to what we talked about originally, Jack as an option buyer has the right to buy at a set price, in this case $40, and Jill has the obligation to sell, assuming that the strike price ends up over $40. Now, generally, we're going to be thinking about things in terms of the expiration date, which in this case is August the 1st. But as the buyer of the option, Jack could actually exercise this option at any time before August the 1st. Okay, so, and you will see this from time to time when you're selling an option and say July the 25th rolls around, boom, it gets assigned to you because it's already way above, the stock price, and, your sales get assigned and sold off right away. By the way, that's the best case scenario for you. If you, sell a call with a strike price of 40, it goes up to 45, and then it gets assigned. You're out of the trade and you've got the maximum profit. But anyway, you can kind of see how that fits together when thinking about this example with Jack and Jill. Okay, so let's continue the analogy and show you these profit and loss diagrams. And we'll start by going through the buy side of the equation. So if you're buying a call, and again, we're going to use this $40 strike and a $2 premium. But if you buy, you have limited downside because you can't lose more than the $2 that you paid. Now, $2, of course, is 200 because it's always times 100, or it's 100 times, it's $2 times however many hundreds of shares that you bought. But we'll just assume 100 shares here. So you can't lose more than the $200. But there's really no limit to how much you could gain. So you see how the arrow goes up. Obviously, if you get to a $52 strike price, your gain is going to be $10 on that, or $1,000. Okay, so your losses are capped, but your upside is not capped. And then the opposite is true for buying a put. Again, your downside is capped at $2, but if that stock price were to drop down way below that, there's literally an unlimited downside. Well, it is limited because it can only go to zero. But for the most part, it's unlimited downside with limited upside. All right, so now let's look at option selling and the profit and loss diagram for that. Starting with the selling a call, again, we're using the $40 call and the $2 option premium. In this case, again, you have a capped upside of $2 with unlimited downside as the seller, okay? And of course, doing that with a put, it's the same. You're capping your gains at $2 and you have unlimited downside. Now, when you think about this in terms of how much option premium you're collecting versus the downside there, you're probably thinking that, man, obviously buying is clearly the best choice, but not so fast. It's really not. And I'll show you a lot of details here in a moment that confirm that selling, even though you are capping your gains, long term over, I like to think about things, if you do it 1,000,000 times, what percentage of the time will you gain? And the odds are absolutely in your favor by selling versus buying. And I'll show you that detail here in a moment. All right, so let's talk about in the money versus out of the money. So in options trading, the difference between in the money, and you'll see it categorized as ITM, and out of the money, or OTM, is the strike price's position relative to the market value of the stock. So an in the money position is when the current price of the stock is higher for a call or lower for a put than the strike price. Okay, that's also known as the intrinsic value. Out of the money is when the current price of the stock is lower for a call or higher for a put than the strike price, and that's also known as the extrinsic value. Now, as I said, I get confused with intrinsic versus extrinsic, so I don't like to use extrinsic at all. I would just think about that as the time value of an option. And I'll illustrate that in more detail on this very next slide. Okay, so let's go into a little bit more detail on this concept of intrinsic versus time value. So option buyers must pay a time premium to purchase a call or a put. So I've got 3 different examples here to go through. The first one is an in the money example. So in this case, the stock price is $40 and the call strike is $38. So it's the intrinsic value is $2, right? And that's the difference between $40 and $38. So it's worth a minimum of $2 at that point. But in this case, it's got a $2 time value as well. So when you take the intrinsic value of $2 plus the time value of $2, that's a total of $4 for the option. Now, if this were to go play itself out, so let's just say it kept closing at the same price, that same stock price of $40 all the way throughout, that time value is going to go down every day until it eventually hits 0. Okay, so the intrinsic value never goes away in this scenario. And again, I'm assuming the stock price stays flat at $40, but your time value will erode over time. Okay, the next example we'll go through is what we'll call an at the money, and this is ATM. And again, this is when the stock price is at $40 and the strike is at $40. So there is no intrinsic value, right? It's sitting right at the strike, it's at the money. But we're going to assume in this case a $3 time value, okay, making the total $3. And just like I said in the previous example, if it were to continue to close at $40 until expiration, that $3 of time value will eventually go down to 0. And this would expire worthless because it's at the money, it's not in the money. And then the last example would be an out of the money situation. So once again, in this case, I've got a stock price of $40, which is the same in all 3 examples, but this time the strike is at $42. So once again, I have no intrinsic value whatsoever because the strike is higher than the stock price. And again, I'm going to assume a $2 time value. And of course, as long as that stock price stays below $42, that time value will go from $2 down to 0. Now, the one thing to kind of look at when you're comparing these is how much of a move do you have to make just to break even? So going back to that very first in the money scenario, we need a 5% move to get to the $42 in order to even just break even. On the at the money scenario, our break even is $43, so we need a 7.5% move. And then on the out of the money scenario, my break even now becomes $44, which requires a 10% move. So this starts to illustrate a little bit on how much movement you need in the stock price in order to profit when you are buying a call in this case, right? So you basically start off down and you've got to have a pretty good move just to get you to a break-even point. So the opposite is true as an option seller. Bottom line is you start off up, and as long as the stock doesn't move beyond a certain point, you are going to maintain that winning position. And as I mentioned, and I'll show you this in more detail in just a few minutes, that happens way more times than not. So let's take this down to another level of detail by looking at how buyers versus sellers perform. Now, there's been a ton of different research on this, and all of this is actually quite quantifiable. But let's look at the profit and loss expectations. So the winning percentage is on option sellers, particularly those selling out of the money options, which is what we're going to do as part of this strategy. They're going to win about 60 to 75% of the trades. And the reasons for that is that options are priced with a time premium. So as we just discussed, once you've sold it, you're actually starting off in a positive position. And as that time premium fades away over time, you're going to be a winner, as you'll see here, a high percentage of the time. And most options do expire worthless. Somewhere between 70 and 80% of options never get exercised. Okay, and of course, as a seller, we're happy to see these things expire. Option buyers achieve profitable outcomes less frequently, typically somewhere between 30 and 40%. However, some of their successful trades can yield substantial returns. Now, the opposite is true for an option seller. You're going to win way more often, but you are occasionally going to have a big loser. So the profit and loss distribution, sellers have a positive expected value per trade, but are exposed to large losses during negative market events or just a negative stock event. And buyers lose small amounts frequently, but can occasionally have very large wins. So when you think about kind of the behavioral and structural edge, market makers, institutions, and smart money typically sell options. We're going to be the smart money here, okay? Retail traders are usually net buyers, treating options like lottery tickets. And this dynamic often leads to overpriced options, statistically favoring the sellers. Okay, let's pull that all together and kind of summarize it. Option buyers have a high reward on a directional move. The profit source is on big moves in price. They're going to win between 30 and 40% of the time. And their average profit or loss is small gains or losses most of the time, with occasional large wins. And then option sellers, their goal is to collect premium and profit from the time decay. Their source of profit is price stability and time decay. Their win rate's going to be between 60 and 75% of the time. And the average profit or loss is small, consistent gains with occasional large losses. Now, it's these occasional large losses that kind of scares a lot of people away from wanting to sell options. But if you're playing the odds, this is the place to be. It's almost like a casino, if you think about it, right? The vast majority of the people coming into a casino are going to lose. And they may be losing small amounts, quite frequently. But occasionally somebody's going to come in there, get lucky, get hot, and make a lot of money. In this scenario, you're the casino, right? And would you rather be the casino or the player who's trying to win basically with the lottery ticket? So we'll finish up this section by going through actual results in my personal account since February 2024, which illustrates the profit and loss dynamics that we've just been through. So during this time, I've had a total of 331 trades placed, and the average winning trade has gained 12.9%, while the average losing trade has lost 18.13%. Now, obviously, we're losing consistently more than we are winning, but this is offset by the fact that the ratio between winners and losers is 2.76 to 1. So almost 3 to 1 winners versus losers. Now, looking at this graphically, you can see the same data here. This literally details out all 331 trades. And again, visually, you can see that the losses are bigger than the gains, but there are a significantly more gains than losses in terms of just the straight numbers. Now, I will tell you that, of course, past results are not indicative of future returns. And it is very important to understand that through this same period of time, the covered call naked put has gained 74.63%, which is outstanding, obviously. But you must obviously realize that the S&P 500 has been up almost 28% during that same time frame. So we are clearly looking overall at a very favorable market. But as you can see, the ratio is actually, I don't have it down here, but it's 2.56 to 1. The Bull Strangle strategy, covered call naked put versus the S&P 500. And then graphically, you can kind of see on a month-to-month basis how this is performed. Now, you will notice that through literally almost October or September, and I'm looking at the bottom right here, these results were actually quite flat, one compared to the other. I'll tell you what's really changed things and helped cause this great separation is I was just trading monthly options up through the first part of this whole time frame and switched to the weekly cycle and have been continually working on stock picking. And you'll see this in video too, but the stock picking has been outstanding for the last many weeks now. And this is what's really started to cause this separation. Okay, to summarize video one, we started with an introduction to a combined stock and dual option income strategy. This strategy combines three strategies into one single position, which is a long stock, which allows for participation in price increases and dividend payouts, a covered call out of the money, which limits some upside potential in exchange for receiving premium, and a cash secured put out of the money, sometimes called a naked put, which generates income while creating an obligation to purchase additional shares. And the whole purpose of our strategy is to earn income by selling options on both sides of the stock price. We're going to use the collective premiums to reduce break even on the long stock. And this strategy works best in range bound or bullish markets but does reduce your downside in a bearish market. Dual Edge Research offers 2 powerful newsletters with one simple deal. This video has been about the Bull Strangle stock and option newsletter, but we also offer the Smart Spreads commodity futures newsletters. You can get both newsletters for the low price of $49 per month, with deep discounts available for 3-month, 6-month, and annual subscriptions. The annual subscription is a 35% discount, and for a limited time, you can get your first month for just $1 by using the coupon code on the website. Go to bullstrangle.com/products to purchase.